Hello Sector Watchers, welcome to the show. This is the 168th episode of Sector Spotlight for Tuesday the 21st of March, and I'm recording this on Monday the 20th after the close of the US markets. My name is Julius Kempenaer and I am presenting to you from Amsterdam in the Netherlands. You can find my contact details on the screen, so feel free to interact and leave your comments under the videos, in the discuss section under the blog articles, or simply drop me an email. This week I'm going to talk you through my assessment of what's going on in terms of sector rotation and how that connects with my observations of the S&P 500 chart. Following that assessment of current market behavior, I want to bring something to your attention which is a little bit outside the box and maybe outside the scope of this show, but I'm going to do it anyway, as I find it an intriguing concept and I'm very curious to hear your thoughts about it as well. And lastly, I'll be answering 2 emails from the mailbag with a few questions related to the reading and interpretation of RRG charts. Ladies and gentlemen, this is Sector Spotlight. Let's make a quick assessment of current sector rotation as it stands at the moment after again, a very eventful week and also an eventful weekend, at least for people here in Europe who are maybe even remotely connected to the financial markets. But the big talk of the town, the big event obviously was the takeover of Credit Suisse by UBS. That's a thing. I think that was history in the making as it unfolded over the weekend, and we'll have to say how it works out. But after one day of trading today, I think it's actually pretty good. I was watching the share price of UBS when it opened this morning, and it opened down about, I think it was 10%, and at the end of the day, shares of UBS were up 1.5%. European markets in general opened down, financials down 3-4%, and at the end of the day all those losses were recouped and even small gains were recorded. And I was thinking about that because if you look at all the bad news that was sprinkled out over the market, not only last week, but even the weeks before. A lot of banking crisis, a lot of, they talk about rate hikes, recessions. There is one bad news item after another was coming out and was raining down on the market. And the market didn't move down, not really. So when you have so much news that can be considered bad news and the market doesn't respond to that, I think that's a sign of strength. I mean, people who were looking for an excuse to sell were served a plethora of excuses to sell, and yet they didn't do it. They didn't do it yet. So my observation at this moment remains that, and let's look at the RRGs right now because that's our tool, that the technology, like growth orientated stocks, I wrote an article for the newsletter about it this weekend. You got consumer discretionary, especially technology and communication services, are showing a lot of strength, a lot of relative strength, and consumer discretionary is leveling off since last week. But that tail looks really good. So that is a market that is moving towards tech and communication services, and discretionary seems to be following. Where is it moving out of? We've talked about that many times. Out of defense, out of staples, out of utilities, out of healthcare. I think that's a meaningful rotation that we need to be aware of, and combine that with what I just explained, that there were plenty of excuses for people to sell, and they decided not to do that. As a matter of fact, everything that was sold was bought back up pretty quickly. it resulted in this daily RRG here, where you see at least technology and communication services completely aligning with what's happening on the weekly. So these two sectors, XLC and XLK, are definitely leading the dance at the moment. Because of the, slight weakness that we saw last week, you can see that healthcare, staples, and to a lesser degree utilities are picking up. But it's not enough to make that really worrisome. Here also you can see that consumer discretionary is crossing over into the improving quadrant. It's actually coming back up. So that little period of weakness that we saw here on that weekly tail seems to be coming to a completion. And if the consumer discretionary sector can follow up with this rotation back up into improving and following through to leading, that would be really strong, and we really would have like all the really growth-oriented sectors back up in the leading quadrant, supported by the move of the daily tail. So for the time being, I see a market that is in transition. There's a move going on outside of defense into offense, or if you want, out of value back into growth. So how does that translate on the SPY chart, on the chart of the S&P 500? I think it translates that transition of the market pretty well. We had that breakout above that falling resistance line on the weekly SPY chart, and then subsequently the drop back, the break of that rising support. So this is kind of in limbo. We broke resistance, we breaking back to support, and we're now holding. And as I said, the series of higher highs and higher lows is still intact. The low here is not really confirmed, but last week the low was 379. And I think we're looking here at 373, 370 area as the previous low. So if this is really the low, if at the end of the week it appears that this was last week's low was the new low, then that is a higher low being put into place. Bit early to call yet, but that is definitely something that is possible. If we go to the daily chart, then we can see that the downtrend is still in play. We see lower highs and lower lows, and the recent rally of the last 7-8 days, this is a low in place on the daily. This low is definitely put into place, but we still have some resistance to overcome around 405, and support here is around 380, and we're struggling with that 494 area. So on the daily, there is still some weakness. We're still in sort of a downtrend. On the weekly, the uptrend is still intact. It's not been broken yet. Kind of perfectly aligns with the transition of value to growth and defense into offense as we see it unfolding on the RRG. So that's my take on the S&P 500 for the time being. Transition still going on. Move to growth out of value. Move to offense out of defense. S&P needs a little bit more time to actually make a decisive move. Something that I wanted to share with you is maybe a little bit out of the box and not really, well, it is in a way related to RRG and technical analysis, but it's a bit outside the mainstream. And let me tell you how I came across this subject. In a former life, probably most of you are not aware of the fact that I used to be a field hockey umpire in the Netherlands. And I umpired at the highest level. And allegedly the Dutch field hockey competition is the strongest in the world. So players on the field are a lot of international players playing world championships and Olympic games. So you can imagine the intensity of the game. And so I had my fair share of, run-ins and debatable discussions and heated discussions with coaches about decisions that we as umpires took. Here you see a bit of an example of what happened. This is after a game that turned around, and the coach that is talking to me, I hope you can imagine me, this is about 10 years ago, a lot younger, a lot smarter, a lot better looking. But this obviously was a debate on something that didn't go as at least that coach thought it should be going. That was a long time ago, and right now I am involved as a coach and an assessor and a mentor for umpires who are umpiring at that level. And from time to time we have workshops and we do extra trainings and we do education and we have external speakers. And a couple of weeks ago we had one of those days on a Saturday, and one of the speakers was a psychologist, coach, trainer, and he came up with the concept of what's called the ladder of inference. And I had never heard of that, but I was impressed and surprised by that model. And let me bring that up for you. So here is that ladder of inference, and let's give credit where credit is due. I found this image. There are many of them. Just Google ladder of inference and you find a ton. This one is coming from commons.wikimedia.org, and it was created by Chris RRGs. There's a lot more stuff of him, but what I want to focus on is this ladder of inference. And what it does, it basically describes our decision-making process. So you got a pool of data, you select from observations. Of course, we have a pool of data. We've got tons of data, price charts, etc. With the selected data, we're going to add meanings to those observations. From that, we are going to make assumptions based on our meanings. Then we are going to draw conclusions from those assumptions. And we adopt those beliefs based on our conclusions, and then we're going to take actions based on our beliefs. And what struck me is that this is kind of the decision process that an investor or a technical analyst or a trader goes through. You observe, you start to attach a meaning to what you see, what you observe, you start making assumptions, you build a narrative. You're going to adopt, like, this is the scenario that I'm working with, and you're going to take actions based on that scenario. Now, where the pitfall where it can go wrong is that we are starting to believe in our assumptions, and we're going to follow up with our assumptions and draw conclusions based on those assumptions without going back far enough to the observations to see if our observations are still backing the rest of the decision-making process. So instead of jumping to conclusions, analyze and test the assumptions. So every time you need to go back to the bottom of that ladder to make sure that your observations are correct. You need to be reflexive. And when that changes, especially for investors, when that changes, you're going to adjust your meanings, your assumptions, and your narrative, and maybe take different set of actions. And that all came together when I remembered that specific case with that coach that was telling me how wrong I was. And luckily enough, we had television images, and we could go back to the situation at hand and analyze it afterwards. And luckily enough, I still believe we were right. Although the decision could have been sold a little bit better or maybe massaged a little bit better. But according to the rules, we were still right as umpires, but we needed to go through that reflection. By the way, the coach did that as well. He apologized for his behavior, so we're all good. But I wanted to bring that back to your attention, that I think that ladder of inference is a great tool for us as investors to keep you on top of your game and realizing every time that you need to make that reflexive loop and go back, like, is the situation on which I based my assumptions and my narrative, is that still in play, and can I still work with that scenario? So that's a sort of a side note, as a, I don't know, call it a little out of the blocks observation, something to give to you to make you aware of the fact that our mind is sort of conditioned to stick with that story, and sometimes that is just not right. You stick with a story, you stick with a narrative for too long, And if you did it as an investor, it can cost you a lot of money. Here's a question from the mailbag, or actually there's two questions from the same person. Maybe three, because I've got another slide as well. It comes from Louis. Louis says, "Hi Julius, please clarify for me, on the RRG on StockCharts.com, what does the width of the tail measure? And the second part of this first question is, what does the separation between the dots on the tail measure?" Now, let's go to an RRG. And if you observe well, and Lewis did that, you can see that the various tails have different widths. Sometimes it's hard to see, but in this case it's very easy. You see that XLRE has a much thinner tail than, for example, XLY or XLK. And you can see that XLI and XLB are a little bit in between. The width of the tail measures the distance from the center of the chart. So the further away from the center of the chart, the thicker the tail becomes. And the closer by, the thinner the tail becomes. The reason is that the further away a security is from the benchmark, the more potential alpha it has. The bigger the diversion, the difference from the benchmark, the stronger the relative strength. So that is, we're trying to acknowledge that by changing the width of the tails. That's the first part of the question. The second one is, what does the difference between the observations mean? The difference between the dots here, we call that RRG velocity. It measures the speed of movement, the velocity of the movement. And the wider the segments are, the bigger the segments are, the stronger the move is. See it as some sort of a momentum measure. And you can see here that in XLRE, these dots are all relatively close together. So these are short segments, and that means a low RRG velocity, which is a small, not very meaningful move. If you look at the observations, for example, on technology, they are much bigger. These segments are much bigger, creating a longer tail. And you know that longer tails mean more momentum, more power behind the move. And a really good example right now is the daily tail on the financial sector as it moved into the lagging quadrant last week. And see how big these segments become, and they become bigger and bigger and bigger, and there's really an acceleration visible there. So that RRG velocity tells you something of the strength and the power of the move that is going on. And the second email I got from Louis, literally a couple of minutes after the first one, so I'm taking this as one, is, "Hi Julius, please help me to interpret the relationship between two ETFs on an RRG and on a price chart. The attached RRG shows SPY and VNQI. VNQI is just to the right of the 100 mark on the RS ratio axis. This shows its relative strength is in a very slight uptrend, but really similar to SPY. Am I correct with this interpretation?" And then he sends a chart, and the chart shows the raw RS line, which is showing the leg higher in relative strength from the late October low, just with a smoothing which has yet to register the last 6+ weeks of weakness. So let's go to that particular setup. So here is VNQI, that's the Vanguard Global ex-US Real Estate ETF. And here is that same VNQI chart with the raw relative strength and the RRG lines. So Lewis says VNQI is just to the right on the RS ratio scale, which is correct, and very close to the benchmark. So does that mean that it is in a light uptrend close to SPY? Yes, it is. But more importantly, the tail is rotating at a negative heading. So yes, the tail is still in an uptrend according to RRG, because it's to the right of the RS ratio scale, or above 100 on the RS ratio scale. and very close to the benchmark. And if you look at the chart that leads or powers this RRG, and here is that raw RS line. And as you can see, that is a big downtrend. And the RRG lines have picked that up going back to 2019, March 2019. And you can see that the red RS ratio line all the time has moved below 100. A couple of times just shaved off that 100 level, and then recently pushed above it a little bit. And if I would scroll this back through time, and let's make it 5 years, so we've got all that history. And let's go back to when it started. So that was sort of May 2019. May 2019. So that is right here. And we then scroll through time. You can see that it moves into the lagging quadrant. That's what you see happening right here. And then all the time, that tail remains on the left-hand side. And you see those rotations taking place on the left-hand side. That's every time you see that green line going back and forth above 100, that's the rotation on the left-hand side of that plot. And that continues, and then we have this, that's happening April 2022, that's right here. That's where we sort of shave that 100 line, so it doesn't really happen, just a notch, and then we go down again. And then recently we move into that leading quadrant. So that's the first bigger recovery or loss of downside momentum since that entire move. So what happens on the RRG is that it picks up this move that you see right here from that October low to that January high. And it picks that up as if a new uptrend has started. The uptrend in momentum was earlier, and we cross above it somewhere in November. And you can see that when that RS ratio line moves above it, the momentum line immediately starts to decline. So that tail starts to roll over. And that trend here, if you isolate this trend, it's sort of sideways and it's in line with what's happening in the S&P 500 because it's sort of sideways moving to the S&P 500. So the interpretation there in the basis is correct. We are in a mild uptrend versus the S&P 500, but at the same time, you can see that that tail is rapidly rolling over and with bigger segments heading towards the lagging quadrant, making it a dubious trend, a trend that should be treated with caution, because you can see that both have rolled over. The RRG heading is moving towards the lagging quadrant. It's a negative angle, making it a dangerous graph or a dangerous ETF to invest in. So I hope that clarifies that you got to look at the interaction between the position of the ETF on the chart, like that last observation, and bring that into perspective by looking at the tail and where it moves. And the ultimate comparison is obviously, and that Louis is doing that correctly, by bringing in that raw RS line and the RRG lines with the chart to bring that all together into one opinion. My opinion here would be that this is a dangerous rotation. It's the first hiccup after a very long weak trend. So I would doubt this to begin with, especially because that tail sort of immediately started to roll over when it entered the leading quadrant and started to move lower. That's usually not a very good sign. And bring in the price chart and you see that VNQI has just dropped below its previous low. That's also not a very good sign. So all in all, the position of the RRG, the tail, the direction of the tail, and the price chart, I'd say stay away from VNQI for the moment. And with that, we have come to the end of another episode of Sector Spotlight. Ladies and gentlemen, thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. You can catch the replays and watch previous shows on StockCharts YouTube channel or any of the on-demand channels. If you'd like to engage in a conversation, you can do that in the comments under every video on YouTube or in the Discuss section under every blog article. Alternatively, find @RRG Research on Twitter, Facebook or LinkedIn, or simply shoot me an email. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.